jumping straight into IREN today. Everyone is watching the price action, but the real story is the massive pivot to AI cloud infrastructure.
Exactly. You tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you are looking to simplify your portfolio strategy and get straight to the signal and all this noise, make sure you subscribe and hit the like button. It really helps us get this information out to more people like you who are trying to navigate these wild markets.
Okay, let's unpack this. We're looking at IREN today. And honestly, if you've been looking at the charts recently, wild might be a massive understatement.
That's one way to put it.
We saw the stock jump, what, 14.6% in a single session? That is what the traders like to call face-melting price action.
It definitely grabs your attention.
But moves like that usually signal something deeper than just a good day on the trading floor, right?
It has to. As we always say here, price is just the headline. The story underneath is what matters. And with IREN, we are witnessing a fundamental identity crisis, or maybe a metamorphosis.
This isn't just a Bitcoin miner having a good week because Bitcoin went up. This is a company attempting a high-stakes transformation into a cloud computing titan. They're essentially trying to convince Wall Street to rip up their old ID card and issue a new one.
Right, and that's the teaser everyone is whispering about. They are moving from this volatile, unpredictable world of crypto mining into the high-margin, high-growth world of AI infrastructure. And they aren't doing it quietly. There's a $9.7 billion figure attached to this pivot that we need to talk about.
That's a massive number for a company of this size.
It is.
It is the anchor for the entire bull case. But before we even get to the specific deal, we have to look at the financial rocket fuel that is supposedly going to power this pivot. Because if you look at the analyst projections for 2026, they are incredibly aggressive.
Aggressive is one word for it. Let's look at the revenue. Analysts are forecasting $1.192 billion for 2026.
Okay, but put that in perspective for us.
To put that in perspective, the 2025 estimate is around $501 million. We are talking about 138% growth in a single year.
Wow.
That is basically doubling the business and then some. My question is that physically possible, or is this just spreadsheet magic?
It is physically possible, but it requires perfect execution. And it's not just top-line growth, which is just raw sales. The quality of that revenue is changing.
Oh.
That's the key insight here that a lot of retail investors miss. When you are just mining Bitcoin, your margins fluctuate wildly. If electricity costs spike or Bitcoin dips, your profit vanishes.
Sure.
But when you move into AI cloud services, you start seeing what we call operational leverage.
Okay, let's break that down for the listener who might hear operational leverage and glaze over. What does that actually look like on the ground?
Well, think of it this way. It costs a fortune to build the data center, the concrete, the cooling, the security. That's your fixed cost. But once it's built, adding a new customer or running the servers doesn't cost you that much more incrementally. So as revenue goes up, your costs don't go up at the same rate. The profit margins expand.
So the first dollar is expensive to earn, but the millionth dollar is cheap.
Exactly. The projections for their EBITDA margins, basically their operating profitability before the accountants get involved, are expected to expand to nearly 55% in 2026.
And what were they before?
For context, they were sitting around 41%. That is a massive jump in efficiency. It means for every dollar they bring in, they are keeping 55 cents of it as operating profit.
That flows all the way down to the bottom line. I see the earnings per share, or EPS, expectations for 2026 are sitting at $1.02.
Which is a huge jump.
Compared to 2025, that is a 161% jump. Investors love growth, but they pay a premium for profitable growth.
And that is the distinction. A lot of AI companies are growing revenue but losing money. IREN is projecting massive profit growth, but, and this is a big but, spreadsheets are just guesses until someone signs a check.
Which brings us to the Microsoft anchor. This is the part that makes this pivot feel less like a PowerPoint presentation and more like a real business plan.
It changes the entire investment thesis. We are talking about a 5-year AI cloud deal with Microsoft valued at $9.7 billion.
Ew.
When you have a name like Microsoft signing on for 5 years, you aren't just a speculative miner anymore. You are an infrastructure partner to, the biggest company in the world.
The magic words here, though, aren't even Microsoft. The magic words are recurring revenue.
The holy grail of business models. Think about it. Bitcoin mining is lumpy. It's inconsistent. One month you are rich because the hash rate is low and price is high. The next month the difficulty adjusts or the price crashes, and you are squeezing by.
Investors hate uncertainty.
They do. But this is about stability. They are targeting over $500 million in annual recurring revenue by early 2026.
And looking further out, the goal is what? $3.4 billion in annualized AI cloud revenue by the end of 2026?
That is a staggering amount of money for a company that, until recently, was viewed mostly as a crypto play.
Right.
It creates a floor for the stock. That's the important part. If you know that $500 million is coming in the door every year, regardless of what Bitcoin does, you can plan, you can borrow cheaper, and you can invest more aggressively. It lowers the risk profile of the entire company.
But I have to play devil's advocate here. Microsoft has deeper pockets than anyone. They could build their own data centers. They could go with Amazon or Google. Why IREN? What does this mid-size miner have that makes them special enough for Microsoft to write a nearly $10 billion check?
It comes down to power. Specifically, renewable power. We talk about moats in investing, the thing that protects your castle from competitors. IREN's moat is its renewable energy-powered data centers.
Because AI is thirsty, right?
Thirsty and hungry, AI is incredibly power-intensive. We're seeing a global bottleneck in getting enough power to the grid to run these massive GPU clusters. You can buy all the chips from NVIDIA, but you can't just plug them into a standard wall socket. You need industrial-scale power. IREN has secured these proprietary power assets, and because they are renewable, they offer a solution that doesn't come with the carbon footprint baggage.
That's a crucial point. If you are Microsoft or Google, you have these public net zero climate goals. You can't just plug your AI brain into a coal plant without taking a massive PR hit and violating your own charters.
Yeah, way.
So IREN is selling them a clean conscience along with the computing power.
Exactly. And there's another layer to this moat, switching costs. Once a client like Microsoft moves their workloads into IREN's data centers, it becomes very, very difficult to leave.
This is the concept of data gravity, right? I've heard that thrown around.
Yes. Think about it physically. Moving petabytes of data is slow and expensive. Reconfiguring your computing power to a new provider is a logistical nightmare. It creates a sticky ecosystem. Once they are in, they tend to stay. So that 5-year deal is likely just the beginning.
Let's pivot to their bank account for a second. Because building data centers isn't cheap. You mentioned operational leverage earlier, but you have to build the factory before you get the leverage. Can they actually afford this build-out?
That is usually the killer for these growth companies. They drown in debt trying to expand. But IREN's financial health is surprisingly robust. They have a debt-to-equity ratio of just 0.34.
For the listener who isn't a CFO, why is 0.34 good?
It means for every dollar of equity ownership, they only have 34 cents of debt. Many infrastructure companies run ratios of 1-to-1 or even 2-to-1. IREN is very underleveraged. They're not owned by the banks.
So they have room to borrow if they need to?
A lot of room.
And are they liquid? Can they pay the bills today?
Very liquid. Their current ratio and quick ratio are both 5.52. A ratio of 1 means you have just enough cash to pay your short-term bills. 5.52 means they have more than 5 times what they need. They have a massive buffer.
And I notice they aren't paying dividends. I assume that is deliberate?
Absolutely. And they shouldn't be. This is a pure growth play. Every cent of free cash flow is being aggressively reinvested into more data centers, more chips, more power capacity. You don't buy IREN for a quarterly dividend check. You buy it because you believe they are building an empire that will be worth 10 times more in 5 years.
And it looks like the smart money agrees with that. We are seeing institutional ownership at around 41%. I saw that Farther Finance added a decent chunk recently, about $2.8 million worth.
It's a vote of confidence. Institutions don't usually throw millions at a company unless they've done their homework. They are betting on the execution.
Okay, that is the rosy picture. The revenue is skyrocketing, Microsoft is on board, the balance sheet is a fortress. But we have to be real. This is the easy money show, but making money here hasn't exactly been easy for everyone. There is a bear case we need to unpack, and it is significant.
There is always a bear case. And with IREN, it starts with what I call the crypto hangover.
Right. Even with all this AI talk, they are still a Bitcoin miner. They haven't sold that part of the business.
They are, and that means they have a high beta. Currently, the beta is 4.25.
For those listening who don't speak Greek finance terms, what does a beta of 4.25 actually mean for their portfolio volatility?
It measures how much the stock moves relative to the broader market. So a beta of 1 means it moves in lockstep with the market. A beta of 4.25 means it moves more than 4 times as intensely.
Wow.
If the S&P 500 drops 1%, IREN could theoretically drop 4.25%. It cuts both ways. It goes up fast, as we saw with that 14% jump, but it crashes hard. It is not for the faint of heart.
So despite the pivot, the market still treats them like a proxy for Bitcoin.
To a large extent, yes. Until the AI revenue becomes the dominant number on the balance sheet, until it eclipses the mining revenue, the stock price is going to be tethered to the volatility of crypto. If Bitcoin takes a nosedive, IREN is likely going down with it, regardless of how well the Microsoft deal is going. That is the frustration for long-term holders. You can be right about the AI thesis, but still lose money because Bitcoin had a bad week.
And speaking of things going down, we have to mention the recent earnings. It wasn't all sunshine and rainbows. In fact, it was kind of a disaster relative to expectations.
No, it wasn't pretty. They missed their Q3 earnings expectations by a mile. The market was expecting a profit of 14 cents per share. Instead, they reported a loss of 34 cents.
Ouch. That is a 48-cent swing. That's huge. How do you miss by that much?
It highlights the execution risk. Pivoting a company is expensive, and it is bumpy. It is one thing to say you are going to build AI data centers. It is another thing to actually get them built, plugged in, and running efficiently without blowing up your costs.
Right.
They likely ran into higher setup costs, maybe some supply chain delays. That miss is a stark reminder that this transition isn't going to be a straight line up.
And maybe that is why we saw some selling. We mentioned farther finance buying earlier, but not everyone is sticking around.
Right. We have to be balanced here. Gladstone, for example, reduced their stake significantly by about 51.6%. They sold over 35,000 shares.
Why would a big fund sell half their position if the future is so bright? Are they seeing something we aren't?
It could be a few things. It could just be profit-taking after a volatility spike. Or it could be concern over the valuation expansion. When a stock price runs up on future promises, like 2026 revenue, some conservative funds prefer to cash out rather than wait and see if the promises come true. It's risk management. They might look at that earnings miss and say, let's take our money off the table until they prove they can execute.
That makes sense. It's essentially saying, I'll buy back in when you show me the receipt, and the valuation concerns are real. We have seen the stock make 9% gains in a week, only to retrace 5.5% immediately after. It feels very skittish.
It's incredibly choppy. And there are some bearish signals flashing on the technicals. There was a short setup flagged recently, which basically means some professional traders are betting on a price drop. They think the hype has gotten ahead of the reality in the short term. They look at that earnings mess and think the stock is overpriced right now relative to its current earnings, not its future dreams.
So we have the bull case, huge growth, Microsoft deal, great balance sheet, and the bear case, extreme volatility, execution risk, and some recent earnings misses. If I am a listener sitting on the sidelines or maybe holding a bag wondering what to do, what should I be watching in the next 30 to 90 days?
Key milestones.
Exactly. What are they?
There are 3 or 4 critical things to keep your eye on. First and foremost, the next earnings report.
We need to see if they can bounce back from that 34-cent loss.
Exactly. The market is looking for a rebound. The consensus is eyeing an earnings per share of 43 cents for the fiscal year. Listeners need to watch that number like a hawk.
And if they hit it?
If they hit that profitability target, it validates the pivot and proves the last quarter was just a blip. If they miss again, the narrative could start to crack. Investors will start asking if they are burning cash too fast.
What about the Microsoft deal? Is there a specific milestone there we can track?
You want to watch for news regarding capacity monetization. It sounds fancy, but it just means, are they turning the lights on? Are they bringing that AI cloud capacity online fast enough to actually bill Microsoft and hit that $500 million annual revenue target?
So we need proof of progress.
We do. Contracts often have performance clauses. Delays here would be punished severely by the market. We need to see announcements saying, this cluster is live. That cluster is generating revenue.
And we can't ignore the macro environment. We are still in the shadow of the Bitcoin halving.
We call it the Bitcoin halving afterglow. Remember, the halving cut the rewards for mining in half. That puts immense pressure on the mining side of IREN's business. They need their AI business to ramp up to offset that difficulty.
Right, it's a squeeze.
It is. If the AI revenue is delayed and mining is less profitable, they get squeezed from both sides.
Plus, interest rates.
Always interest rates. This is capital-intensive infrastructure. Building data centers requires cash. Lower interest rates generally boost plays like this because borrowing money becomes cheaper. If we see rate cuts from the Fed, that is a massive tailwind for iron.
And if they stay high?
It keeps a lid on their valuation because the cost of capital remains high.
Let's talk price levels. Where is the battleground right now?
Right now, there is a psychological battle around the $40.30 level. That has been a pullback zone, a support level. But on the upside, analysts have targets averaging around $76.50.
That is a massive gap, almost double.
It is. It shows you the risk-reward ratio here. The market is undecided. The wide gap tells you that if they pull this off, the upside is huge. But the market isn't pricing it in yet because of that execution risk we talked about.
So pulling it all together, I heard a rumor or a description of their strategy recently that I loved. They called it the mullet strategy.
The mullet strategy, business in the front, party in the back.
Kind of, but in this case, it's mining in the front, AI party in the back.
I like that. It actually fits perfectly. The mining business is the legacy. It's the front. It provides the quick liquidity, the cash flow, the immediate resources. It's the engine room.
And the AI party in the back is the future growth.
Right. It's a hybrid model. They are using the business of crypto to fund the party of the AI boom. It blends that quick liquidity of crypto with the stable, massive, long-term growth of AI infrastructure. It is a unique position.
Not many companies can pull off a mullet.
No, but IREN is trying. It's a bold look, that's for sure, and a bold strategy.
It is.
And honestly, it might be the only way for a miner to survive long-term. Pure mining is a race to the bottom because of efficiency demands. AI is a race to the top. IREN is trying to switch tracks while the train is moving.
So here's the question I want to leave you with today. We have laid out the numbers, the deals, and the risks, but ask yourself this. Is IREN a Bitcoin miner pretending to be an AI company to catch a hype wave? Or is it an AI giant that just happens to mine Bitcoin on the side?
That is the multi-billion-dollar question.
Because your answer to that determines the valuation multiple you are willing to pay. If they are a miner, they are expensive right now. If they are an AI cloud provider, they might be incredibly cheap.
Exactly. The market pays a premium for AI. If they convince the world they are the latter, that $76 target might just be the beginning.
That's a lowdown on IREN, a massive bet, a massive pivot, and a fascinating chart to watch.
Definitely one to keep on the radar. But remember, with a beta that high, stay safe in the volatility. Don't bet the farm on one harvest.
Couldn't have said it better. Thanks for tuning in to the Easy Money Show. We'll catch you on the next one.
Take care, everyone.